On this week's episode of Dollars and Cents, we're going to talk about some of the more unique problems that men face in retirement. You often hear a lot of programs and a lot of content about the unique challenges that women face in retirement. And certainly, I know we've dedicated several segments on this show over the years to that. So I thought I would kind of flip the script a little bit and talk about some of the more unique issues for men as they face retirement. And then we're going to include a discussion, as we like to do this time of year during tax season. We always like to kind of include at least a segment talking about a particular tax issue. This week's is going to be your home. Your home can not just be a shelter from the rain and the storm and the heat, but also an opportunity to save on your taxes. So we're going to be going over some of the ways in which your home can, in fact, save you on your taxes. So welcome on in to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. So one of Central Florida's longest running radio programs, also a top 25 financial planning podcasts as well. So make sure you check us out on your favorite podcast platform, or just visit our website, nelsonfinancialplanning.com, and there you'll see ways in which to get immediately connected to our channel on the favorite podcast platform of choice, along with, of course, our YouTube channel, where you get to see us do the show in our very own Nelson Financial Planning Studios, located at our office in beautiful Winter Park, Florida. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom are certified financial fiduciaries, and they stand ready, willing, and able to help you improve your life with a successful and cost-effective financial plan. Speaking of some of the folks on the team at Nelson Financial Planning, last week on the program, certified financial fiduciary and IRS enrolled agent Christina Lamb joined us. And so I've got a few follow-up sort of items from that program. If you recall, we taped that particular show on the Friday in order for me to participate in the Florida Marathon, sponsored by Publix, over in Melbourne, that was held last Sunday. It was a hot day out there, and so not exactly setting world record speed on a personal basis, but I did manage to finish. That's marathon number 4, so that's good, and live to tell about it. But yeah, it was kind of hot, and that if you've ever tried to run when it's kind of getting hot, it doesn't really help. You'd like the temperatures to be a little bit cooler. That would have been ideal, but be that as it may, still managed to, cross the finish line. Jamie at the office posted some pictures if you're interested on our Facebook channel, so you can check it out and comment about how tired I look at the end of the race. I was actually sore for the first 2 or 3 days of the past week as well. But anyway, so that's that follow-up. Also this past week, of course, it was Valentine's Day on Friday, so we hope you had a good Valentine's Day. The main economic news, which is what we really want to turn to for this past week, was Wednesday's inflation data, right? That's the thing that hurts at the grocery store when you go shopping, right? That rising price of goods that unfortunately we've seen a lot of over the course of the past few years. The inflation reading on Wednesday came in a little bit higher than what it was in December. So the inflation reading came in at 3%, which was about 0.5% higher than December's reading. More troubling, I guess, as you started looking through that economic data, was that the Michigan survey of sort of expectations by the consumer for inflation, for the year ahead, in a 30-day period, increased from an expectation of 3.3 to up to 4.3 for February. So that was a pretty big jump. and obviously kind of reflects some of the concerns about the potential tariffs that are obviously getting a lot of conversation out of Washington about. And I guess the reason that we note sort of the expectation or the inflation expectation by the consumer in that survey, and why we're noting it on the program, is that sometimes your expectation can become reality just by simply expecting it, right? And this expectation of a little bit higher inflation can certainly weigh on consumer purchasing decisions, and in fact have more of an impact than sort of what is actually happening. So that was a little bit of a, kind of a negative, I guess, to that overall inflation economic data that came out on Wednesday. The flip side, of course, is you have to remember that January, the inflation data often reflects the fact that many businesses choose the beginning of the year to raise prices. So some of that, might have been part of that inflation data. Of course, any inflation data is important, not just at the grocery store, but obviously that's one of the items that the Federal Reserve looks at most carefully in order to determine whether it's going to continue to cut rates or pause or even increase rates. For what it's worth, markets didn't seem to particularly troubled one way or the other in terms of that data. So of course that was good. So that was kind of the sort of the economic recap, if you will, for the week. Another follow-up from last week's show is that I wanted to spend some time. We were talking about sort of debunking some of the retirement myths and referencing that recent Charles Schwab survey that said that most people were of the view of, I need 1.8 million saved for retirement. And as Christine and I were sharing on the program last week, many of our clients at Nelson Financial Planning have less than that. Some of them much less than that, and still enjoying a very comfortable and satisfying retirement. And of course, the reality is how much you need for retirement is, of course, highly dependent upon your lifestyle. And so we talked about all that on the program. But I think the part of the conversation that we did not get into, and I wanted to get into it a little bit this morning on today's show, is that the reality is that for many Americans, a lot of people haven't hardly saved anything. So maybe you don't necessarily need that 1.8 million, but you need something in order to be able to retire. And the following numbers that we're going to give you should kind of stagger you a little bit. Only about 16% of retirees have more than $1 million saved. Half of U.S. retirees have saved less than $145,000. And another 1/3 of retirees report having no retirement savings at all. Now, the reasons for all of that range from simply not having saved along the way to maybe you encountered something that was totally unexpected, maybe some health issues, maybe got forced into early retirement, maybe AI came along and changed the nature of your job. And the reason I mention these statistics about how much short the average American is in terms of their retirement savings is simply to emphasize the need to save for retirement. Maybe you don't need 1.8 million, but you need something. And as you can see by these numbers, the reality is that Americans in retirement, it's not going to be a great golden years for many if based on kind of how much the average American has saved. So while the number may not be as big as you might think you still need some. And of course, the key to getting that is all the things that we talk about here on the program on a regular basis, right? Starting early, doing something, doing anything, $50 a month, $25 a month. Make sure you're doing enough to certainly get whatever match your employer gives you at work, being consistent, being diversified. All of those things are sort of key investment concepts that we talk a lot about on the program, and of course in much greater detail in our book, Next Gen Dollars and Cents, which of course, as always, can be ordered from Amazon. I think folks at Amazon charge $14.99. You know, Amazon makes a good bit of profit. But of course, if you listen to the program, you know how you can get your free copy, and that is simply by visiting our website at nelsonfinancialplanning.com and scheduling a free conversation with one of our certified financial fiduciaries. When you come on into the office, they'll slip you a free copy of that book. So make sure you take us up on that offer. With that, we're going to take a break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We hear a lot of conversation about the gender gap, right? And I know there's certainly been many episodes of this program where we've focused on sort of the unique challenges that women face in retirement. And so I thought it might be interesting to sort of flip the script on this week's program and talk about some of the unique issues that men face in retirement. I guess first off, there's clearly a difference in the sexes when you talk about life expectancy, right? Average life expectancy of a man in America today is about 73 and a half years, which is 5 years shorter than women. And it's sort of beyond that, though, beyond, you know, the difference in life expectancy, there's definitely some unique financial and health issues that I think are a little bit more unique to the baby boom generation that is in the midst of transitioning to retirement right now as we speak, and doing so every single day. And those issues, I think, can break down into sort of two parts, right? The first part would be more financial, and then the second part would be more health related. And of course, within health, there's always sort of two parts, if you will, that the physical health and the mental health. And so we're going to start kind of there in the health side of things. Specifically, the mental health side, I've always struck and I always remember a conversation, and boy, this is probably at least 10 years ago, and it was with a male client, and he had been president of a relatively large, relatively well-known local sort of insurance company. And he said to me, you know, Joel, the hardest thing about getting old was the feeling of demotion that you have with that upon retiring. In essence, how he said it was dealing with becoming irrelevant. And when he said that to me, it really kind of struck me of you know, wow, that, you know, there's a lot of truth in that statement, because you go from working, and if you're, have had a long working career, chances are you're kind of, up the food chain, if you will, managing people. And maybe in this individual's case, you rose all the way up to sort of be the head of the organization. And, I like to say you do at that level, you do a lot of pointing and shooting. And what that means is that, you say, okay, here's what we need to do. And you point, and then, and then whoever you're pointing at, they're shot with the task of doing it. And when you retire, you probably can't do that to your spouse, right? You can't, tell them to, just do that stuff. Here's my idea, and I want you to do it. And so the way that he described that, becoming irrelevant, it just always struck me. And I remember that conversation very, very well. And that's probably at least a decade-old conversation. In essence, you go from everybody sort of listening to your opinion and doing what you tell them to do to simply not having that as a part of your life anymore. And that can create some real emotional and mental health issues that are perhaps more unique to men. And unfortunately, this really plays out dramatically when you actually look at suicide rates. Men account for 80% of suicides, and even more disturbing, which is directly on point with what we're talking about here, is that male suicide rate is consistently the highest in men above age 75. Stop and think about that for just a second. That's pretty dramatic. Clearly, that underscores that there's definitely some unique issues that men face when they get to retirement. And we've sadly seen that statistic play out in real life. I remember it very well. This was probably more than 10 years ago, and the individual left behind a spouse. I mean, it's just dramatic, and that's a large part of those unique challenges that men face in retirement. And you know, that's not exactly a heartwarming statistic, particularly with men, you know, in the current baby boom generation getting to retirement a lot of times as well. Beyond your mental health, it's the physical health where they've literally taken that job stress to heart. Literally, I think another study that we saw that found that men in stressful jobs had twice the risk of heart disease as, you know, versus the general public. So that's the tough news, if you will, particularly on the mental health side of things. So how do you combat that, right? I mean, obviously this is a financial show, so it's not intended to be a health show, but health and finances kind of go together, don't they? Particularly if your finances are in bad shape, you can certainly affect your health. And if your health is in bad shape, you can certainly affect your finances. So how do you combat that, right? How do I guess it starts with combating isolation. It starts with combating loneliness in retirement. And it just underscores the importance of getting out there and seeing people and doing new things and remaining relevant to thinking of that client conversation all those years ago. Join a club, make new friends, try something new. All of that is certainly good for you. Make sure you are in a good state of mind. So that's kind of the mental side, right? And then we're going to shift gears to the physical side, right? So that's probably there's a big difference between men and women on that then gets reflected in the whole life expectancy factors, where men have an average life expectancy about 5 years shorter than women. Unfortunately, men, and sorry guys, but less likely to take care of themselves physically, more likely to skip the doctor appointments, which can result in much higher rates of disease and earlier death. Only about 43%, so less than half of men ages 35 to 54 go to see a doctor on an annual basis. And for those over age 55, there's still a quarter or so of the population who don't go for that annual visit either. Just had a good friend, fell into this exact same category. Life gets kind of in the way. And in his case, his primary care physician had retired. And so for the past few years, he hadn't really been going for his annual checkup. He'd been getting some of his meds renewed, through another form. And so finally, after months of feeling tired and out of breath, the simplest things like going up a flight of stairs, he found out, and this was just 3 weeks ago, that he was in AFib. And so now he's going to a slew of doctor's appointments, but would not be nearly as dramatic, right, if had gone to those annual checkups along the way and kind of not quite gotten in the physical shape that he wound up getting in by not going to see his doctor on a regular basis. So how do you fix that? Well, that one's pretty easy, right? You go see your doctor, right? And you go get those regular checkups, and you take the shots, you take the pills, whatever it is, and then try and develop some form of a physical regime that keeps you in good shape. Right now, it'd be crazy like me and go out and run marathons and all that kind of stuff, but you can develop your own routine. I have one male client that retired many years ago and really pursued a love of off-road biking and became a champion off-road biker as he's approaching 60. So something that he'd been involved in and then really wound up getting much more involved in and much better at once he was able to retire and focus on that. Even more impressive is what happened just last week, and this one is going to be pretty impressive. So, but we got to take a break. We come back from the break. I'm going to share that story. I know this segment's been a little bit filled with some stories along the way, but we got one more we want to share with you, which is, I think, pretty neat and pretty impressive. So we're going to take a break here on Dollars and Cents and return after these messages. Talking about some of the unique problems that men face in retirement. Now, you may say, well, I'm not sure they face a whole lot of problems. Well, chief among them is the fact that they've got a 5-year shorter life expectancy than women. That should catch your concern a little bit. But there are some unique problems as well involving health and finances. In the prior segment, we were talking a little bit about sort of some of the health issues, the mental health issues, the statistics involving suicides for men over 75. It's the highest percentage of suicide rate. So you've got to make sure that you are in good mental health when you are in the process of retiring. One of the biggest issues is that you need to stave off becoming irrelevant once you retire. So get involved and engage. And then on the physical side, that's just as important. Before the break, we were telling you the story of a client who retired and had been into bike racing and really got into it once he retired, and now is a champion bike racer. So some neat stories, but I got to share with you kind of one of the most impressive ones, and this happened this past week, and this has to this involves a 93-year-old male client. Okay, 93 years old. And so in the meeting, Chet and I were in the meeting at Nelson Financial Planning. If you're a client, you know that we always really follow a team approach. So any meeting you have, there's always a couple of folks in every meeting. So from that particular meeting, it was myself and Chet, who, if you're regular listeners of the program, you know that Chet's joined us here as co-host a few times on the program. And so we're sitting in there. I don't know quite how we got off topic on it, but somehow we did. And that 93-year-old can do 9 pull-ups. 9 pull-ups. And, I run marathons. It doesn't necessarily make me in the best of shape. Chet, a little bit younger, a lot younger, frankly, than I. He does a lot of working out, does some boxing. He's been in some, kind of amateur fights. And so like 9 pull-ups, that's a lot. Well, he proceeds to take off his jacket and does a flex for us, like we're doing right now. If you're watching the YouTube channel, you do the flex, okay? Like you put the arms up and kind of do the flex, and holy cow! I mean, yeah, that was very impressive, and so we would encourage you to do that. As Nike says, just do it. And he's followed a regime, a workout regimen that he's been doing for obviously a long time, and still in phenomenally good shape at 93. So I'm thinking about that. You do 9 pull-ups, and I'm talking like in a row at 93. Pretty impressive. And I guess part of that and why he's still able to do that is that he follows a pretty good workout regimen. And I would say the same thing. I certainly enjoy running. I've run, kind of all my life. But I find that if I'm following a training schedule for a particular run, that really helps to stay on track. And I think that goes to the fact that structure is such an important thing in so many different things in life, but also to maintain your physical health as well. So some interesting perspective, right? So the answer on that is develop a plan. It doesn't have to be serious, okay? Particularly if you're just getting started, you certainly want to consult your doctor and make sure you're well enough to start a plan, but get a structure, get a plan, because that's ultimately going to help you become more physically healthy. Shifting gears, of course, is the unique financial considerations that apply to men when it comes to retirement. And I think the key issues here are kind of twofold. It involves general understanding of finances and then Social Security, and we'll sort of break those down. The general understanding of finances, I think, falls into the sort of traditional roles that folks that are retiring today, these baby boom couples, sort of particularly fall in. Frankly, at my house, we fall into the same role, but that's probably more related to what I do for a living than anything. But more often than not, the guy is dealing with the finances and the gal isn't, kind of thing. And so that can create some issues, right? Because if the life expectancy of the man is shorter, then ultimately the gal is going to be running the financial show at some point. And the reality is that in most older married couples, the man sort of has traditionally taken care of it. We see this often when, kind of the surviving wife comes into the office with kind of a dazed look of like, I have no idea what's going on with all the finances. But what actually kind of made me smile about all of this is that, as we were preparing for the radio show, kind of talking about this particular topic, lo and behold, just this past week, we had the pleasure of visiting with somebody where they specifically were coming in to us. They'd never used a financial advisor before. It was a couple in their 70s. And the reality is that his primary concern was making sure that his wife had an understanding of the finances and was looking to find a firm where they could develop a relationship with to really help her make sure that she was in good shape to understand the finances, particularly if the law of averages applied and he wound up passing first. And my mom, who's in assisted living now, she says to me all the time, "It's all women here." And I'm like, "Yeah, that's kind of what it looks like." But important to understand that your wife has an understanding of the finances, because that's important to have that understanding and appreciation, so that they're not just struggling and not understand all of that financial picture. Of course, beyond that, in today's world, more often than not, particularly for folks that are of Social Security age, the husband typically collecting more or the higher amount from Social Security. And the reality is, when they pass, the surviving wife is going to wind up with that amount of Social Security, and ultimately, assuming hers is the lesser amount, lose hers. That's how it works. That's how survivor benefits work under Social Security. So having a high level of Social Security income is certainly important to make sure that your surviving spouse is left with the most amount of income that they can get. So how do you solve these unique financial problems that impact men in retirement from a financial side? First, make sure your spouse has an understanding of the household finances. One of the most important things that you can do is create a separate document that lists all the accounts, all the account numbers, the addresses, the passwords, all of that stuff in one document, printed out in a binder somewhere in the house, so that worst case scenario, at the very least, they will know all of the things that actually exist from a financial perspective. And then take the time, at least once a year, maybe even more often than not, to go over with your spouse what the bills look like, what the accounts look like, all of that. Very important to be able to do that. And then before you apply for Social Security, make sure you understand sort of all the different scenarios that come into play, right? And the impact that's going to have, depending upon the decision, the timing, and all of that as it relates to Social Security. That's one of the biggest roles that Rob Field at our office serves. He certainly has joined us as a co-host several times before here on the program. He is a National Social Security advisor and takes a look at those comparisons and those types of things to see what the best option is. So some pretty important takeaways, if you will, to consider to really recognize the distinct roles that men serve, particularly in those sort of baby boom couples that are in the process of retiring now, and find themselves in sort of this more unique set of circumstances that involves the financial side, that involves the health side of things that are truly unique to men as they approach retirement or as they go through retirement. So with that, we're going to take a break. When we come back, we're going to shift gears and talk about your home and the tax benefits that are available to you when you own a home. All of that coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So you know that Rolling Stones song, Gimme Shelter, right? So to quote that song, it says, it starts out, a storm is threatening my very life today. If I don't get some shelter, ooh yeah, I'm going to fade away. Now, clearly, I sound nothing at all like Mick Jagger. And so resisting the temptation to actually break into song as I just simply read those lyrics. The reality is that beyond giving you shelter, your home also provides a variety of tax benefits that we're going to be talking about in this segment of Dollars and Cents. So your home is certainly one of the biggest investments, right, that most people make in their life. And typically, they don't have the cash stashed away to just, put a bunch of cash on it. They typically borrow money, right? And so that loan to purchase a home takes the form of a mortgage where the home is used as security for that loan. Now, the interest on that mortgage then is actually tax deductible. So in order to qualify for that, then the home that we're talking about has to be either your main home, your primary residence, but it also can apply to a second home as well. And in order for the interest to qualify, then it has to be that main home, that second home. You can also borrow against an existing home if you use the proceeds to ultimately improve the home itself. Some limits in terms of how much can get deducted and or how much one can borrow and still deduct the interest. That limit today, mortgage amounts up to $750,000. So pretty big mortgage, or the interest on what would be a pretty big mortgage, all of that interest would wind up getting deducted. Now, the key piece to this and being able to deduct your mortgage interest, it does require you to go through the process of itemizing your deductions, right? So that process where you sort of total up all your itemized deductions, the name of the game there is then that you have to do better than the standard deduction. So the standard deduction is what you get as your deduction under the tax code. You itemize your deductions when you think you're going to do better than that. Now, what has happened of late, particularly post-2017, is the standard deduction has gone up quite a bit. The standard deduction for a married couple for tax year 2024 is over $29,000, $29,200. Single taxpayer, it is $14,600. So your total of your mortgage interest, along with things like charity, real estate taxes, things like that, have all got to add up to be more than that standard deduction in order for it to make sense to go ahead and itemize your deductions. So, but important to kind of go through that exercise and make sure, although given how much higher those standard deduction amounts are, that kind of only really applies to about 10% of the population. But if you have a mortgage, the interest on that is deductible, and ultimately that's one of the benefits of owning a home, because with that you can also then particularly if you're trying to itemize your deductions, so you can use the mortgage interest, the interest on the loan on the house, but then you can also use the amount that you paid for your state and local real estate taxes. Now, if you say that out loud, it's state and local real estate taxes. That's where the acronym SALT comes from. Okay. And we're hearing a lot about this SALT acronym because right now your ability to deduct your state and local real estate taxes is limited to $10,000. Now, in that category is more than just real estate taxes. Income taxes, if you're in a state where you pay income taxes. But again, that's why it's state and local taxes. So that's technically what that SALT definition applies to. The limit there is $10,000, or the cap, if you will. So that SALT cap of $10,000 limits your ability to deduct your home real estate taxes or even your state income tax. Getting a lot of discussion in Washington, D.C. about changing that cap, widely expected to be adjusted upward. So an opportunity to write off potentially more of or a larger share of your real estate taxes. So stay tuned on that one. But that's another way in which owning a home can help on your tax return. In addition, of course, if you are self-employed and use part of your home as your office, you can deduct expenses related to a home office. Now, there's a lot of catches in this one. But first and foremost, it has to be self-employment income. W-2 income does not count and does not allow you to take this type of home office deduction. Beyond that, the portion of your home that you are using for your home office has to be, and the test is exclusively and regularly used for business purposes. And I guess this is where things kind of get tricky, right? Because if you're working on the kitchen table, I don't think that's exclusively used for business purposes, right? You probably eat there as well. And then that would disqualify that home office deduction for you sitting there at the kitchen table. So there's a simplified method that they give on this one where you get to use a rate of $5 a square foot for of a portion of your home not to exceed 300 square feet. And in order to do that, of course, if you're doing that and you've got self-employed income, then you're filing Schedule C, which is where that home office deduction for your home then would show up. Bottom line on that one, make sure you're careful, as the rules on this one are very specific in order to take that deduction. So those are the main deductions involving your home. Beyond deductions, which simply subtract from your income, there's also a number of tax credits. And tax credits, you have to remember, are much more valuable than deductions because tax credits lower your tax bill on a dollar-for-dollar basis. So among those tax credits that are available are some various energy efficient types of improvements that allow for a tax credit of up to like $3,200 for the year. Generally equals 30% of the cost of allowed improvements such as insulation, windows, doors, water heaters, things like that. Be aware that in this category there's different sublimits on the type of improvement that you're doing. So like if you're replacing your windows, there's a sublimit of you can't do more than $600. $2,000 for a heat pump, things like that. So again, make sure you're kind of working this one very carefully. The biggest of those energy efficient tax credits, of course, is the solar credits, right? If you're putting up solar panels on your home, there's no financial limit on that. You can write off as much as you can or as much as the cost was, subject to the limit of 30%. You can only write off 30% of the cost of those solar panels, but it can be for whatever amount. So if your solar panels cost you $50,000, you could write off 30% of that number. So that's a pretty significant credit, and there's no sort of limit to that. So if the write-off is $10,000, you get the whole 10. If it's 12, you get the full 12, etc. So those are some of the different tax credits that can also apply by virtue of owning a home. And then one of the kind of the more unique things about a home is that you actually get to exclude the gain when you sell it. Particularly, now this applies to your primary residence. It applies if it was your primary residence 2 of the last 5 years. And what that means is that if you sell your home, your primary residence, that at least it was for 2 of the last 5 years, then you can exclude up to $500,000 of gain as a married couple. Maybe you saw that in the appreciation of your home. Now remember, gain, you got to look at your net sales price, right, that you actually got when you sold the house versus what you bought the house for, plus any of the improvements that you put in along the way. So the difference between those numbers, assuming that the house sold for more, that is the gain. That gain is excluded up to $500,000. So a very unique, that home seller's capital gain exclusion is pretty unique in the tax code, where you can sell an appreciated asset and not actually have to pay any taxes on the sale of that. So certainly a lot of ways in which your home is more than just shelter. It is, in fact, helps you on your tax return as well. With that, we're going to start to wrap it on up and get on out of here. Thank you for listening to this week's episode of Dollars and Cents. If you have any questions about anything that we talked about, please reach out to us, courtesy of our website at nelsonfinancialplanning.com. While there, if you want to schedule an absolutely free conversation to talk about your particular financial situation, we'd be happy to get that on the calendar as well. Those consultations are done free of charge at all times, and also a great way to score a free copy of our book, Next Gen Dollars and Cents, as well. With that, we're going to conclude this week's episode of Dollars and Cents. This is Joel Garris of Nelson Financial Planning.